live stream, just letting some people join really quick. We'll be starting in a couple of minutes, maybe 1 minute. What's up, Justin Knutson, Lucum's Live? What's up, Beat is this? Who are you in Discord again? I totally know who you are, but I always forget. Is that ups and downs? What's up, Miguel? Yeah. That's too funny, Justin. What's up, Miggy Smalls? Juco, right, what's up, Juco? Alright, what's up, Pennybois and gals? This is just an impromptu live stream. I just wanted to do this really quick, just to go over a few things. I wanted to do this to A, go over risk to reward ratio once again, as well as when to take profit, or when to sell for a loss and how that all works, as well as answer some questions from our PBU members. What's going on, Kev K? Welcome to the stream. So, what is risk to reward ratio? Well, basically, it's one small part of creating a trading plan. A lot of traders get into a play blindly. They say, I think this trade is going to go up, so I'm going to buy in. What's going on, Mafuz? Some more? I probably pronounced that wrong. Sorry for that. So they think this trade is going up, so they're just going to go ahead and buy it. But they don't know, they don't have a plan as far as exiting the play goes, whether it be for profit or for a loss. This usually makes them end up becoming a bag holder by letting the stock drop so far down that they now are losing so much that they can't sell it for a loss without tanking their account. Kev K, that's hilarious. Or it will make it so that they watch the stock go up and they have profit, but they don't sell because they don't have a plan. And they watch all their profits disappear. They break even. Now they're like, well, I can't sell now. I just had all that profit. And then guess what? Now they also become bag holders. Oh, looks like I did pronounce that right. Perfect. All right. So, if you want to get in on... Alright, Alright, so we can't predict the top or bottom of a stock's run. This is why we buy in slowly and penny. Determine how much money we are willing to put into it. So once we figure that out, $200, whatever your account is. Once we figure that out, then oh, whoops, the music came on again. You probably couldn't even hear me, huh? I just wanted you guys to get all that, get that dubstep going on, you know. I did my first trailing stop loss today on MDLY. Stocked out, but now I know how to work. So yeah, that's why we paper trade. That's why we practice. Is, you know, it sucks to lose, but it's all about practicing. Especially, you know, practicing your paper account is the best way to do that. All right, so I know that the music was playing there. So basically, we can't predict the top or a bottom of a stock's run. This is why we buy in slowly at Pennybois. Our PBU buy-in method is what helps us do that. So how does that work? Well, when we see a stock, we first determine how much money we are willing to put into a stock. Once we figure that out, we start buying in slowly. That can be 10%, that can be 5%, 7%, whatever number you choose, or whatever works for you. Then as the stock consolidates, we continue making small buys so that we can get the best average possible. Because remember, you're not averaging down until you're in 100%. The reason that we do this, instead of buying in all at once, is that our alerters alert these stocks before the run. But it isn't possible to guess the bottom or know exactly when that run is going to happen. See, we don't chase stocks. Chasing is for people who don't know how to do technical and fundamental analysis. Our alerters know how to do both, and they do them very, very, very well. So they see a stock and they see that it has a potential for a run soon, so they alert it. That doesn't mean that it's going to run tomorrow or today or the next day. It means that once there's a news event or earnings or any other type of catalyst, then it will start to go up. So, Kev K, bless and knock off 9 Inch Nails. So let's say that they alert a stock at 50 cents. This doesn't mean that the stock has reached its bottom, because like I said, it's impossible to guess the bottom of a stock. This just means that the stock is looking good for the near future. So, because we can't guess the bottom, and we don't want to chase the stock, we get in at 50 cents before the news or earnings or whatever it may be. But because of this, the stock is going to consolidate still while we are in it. Sometimes that means it's going to go down while we are in it. But that's good because we bought in slow. This gives us a chance to develop our position, or average, while the stock consolidates before the run. So we buy in small at 50 cents, let's say 5% of our intended position. So the stock drops to 48 cents. We can now buy some more, let's say another 5%. Then the stock consolidates some more, goes up a little bit, goes down a little bit, eventually dropping down to 45 cents. So guess what? That's okay. We buy some more, maybe 25% this time. So now we are in a total of 35%. The stock now drops to 43 cents, and we pick up 15% more. We're now in 50%, and our average is around 45 cents. Now, that's much better than having an average of 50 cents. So then the stock goes down a little bit more, and then boom, there's news. You know, let's say there's a forward split, or let's say, you know, they got approved for COVID testing, or the oil, they bought a rig of something, or whatever it may be. The stock now starts to show confirmation that it's going to make a run. So we make our last 50% buy, let's say at 41 cents. So now we are in 100% at 43 cents. That's a great average. That's much better than 50 cents. I know that a 7-cent difference might not seem like a lot. You know, 7 pennies, whoa, who cares about that? But for a stock that's trading below 50 cents, that's a huge difference. If you bought 500 shares for around $200, that's a $35 difference, or almost a 5% difference in profit. So instead of making 10% profit, you're now making 15%. Meanwhile, other traders who bought all in at 50 cents might have stopped out already. And the ones who are chasing the news have a much worse average than you. They probably bought in during the news, and now they're in at 48 cents, 50 cents, 52 cents, or whatever it may be. It might not have gone on the radar until it already hit 60 cents. You already took profit. You already made 15% profit. They're just getting in because they just heard about it. So you're probably thinking, how do I know when to make my buys? Well, that's based off of your plan. You can say, I'll make a buy every time the stock drops 3%, for example. Or you can say, I'll make a buy every time the stock hits a support. Or I'll make a buy every time the stock does a candle pattern that I know that is showing a reversal. Whatever works best for you. New traders typically just use a drop percentage because it's the easiest, less stressful way to do it. So it's a stress-free way of doing it. So just saying every time the stock drops 3%, I'm just going to put a buy in there. I'll do 5%, 5%, 10%, 10%, whatever your buy-in method may be. I'm just going to wait for every time that the stock drops a certain percentage. So it could be 1%, it could be 2%, it could be 3%, whatever you choose. And remember, trial and error is how you figure out what you want that percent to be, which is why we paper trade. So, when do you set a stop loss? All right. So let me go ahead really quickly. I promise you I will not be putting in the music this time. All right, so when do you set a stop loss? Well, this is also up to you. You can set it right when you get into the play, or that way, but then you'll risk being stopped out instead of creating your position. So that's the only risk of setting a stop loss right away. This is the least risky way of doing it as far as actual risk goes, but it also has the least amount of reward. So in the long run, it actually is more risky because you'll end up stopping out of pretty much every play and you won't make any money. And the least amount of potential of making profit overall is doing that strategy. I'll buy now when it drops 50% from alert. Hopefully that doesn't happen. By that time, you might want to get out of that play if it's dropping 50%, Kev Cave. I'm still laughing about that 9 Inch Nails reference. So you can also, another plan is you can also wait until you are in 100% and then set your stop loss and then your take profit at when you're in 100%. Or you can wait until you are in 50%. Whatever seems to work best for you, use it. And the way to do that is to trial and error. You get into a play, you wait until you're 50% in, set a stop loss. If that doesn't work for you, then wait until you're 100% in, set a stop loss, and then see if that works for you. Whatever works best for you. And it's all about practice, It's like when you're playing any sport, you practice. You see, oh, maybe if I throw a ball this way or catch a ball this way or hit a ball this way, this is the best way that works for me. You don't know right off the bat. You don't know your first at-bat what, pitch you're going to hit the best. You don't know what kind of pitcher you are until you practice. There's a sports reference for all of you. I know you guys were waiting for it. Don't be sorry, Kev. I'm literally laughing. It was hilarious. The 9 Inch Nails reference, that was too good. So like I said, whatever works best for you. And the only way to figure out that is trial and error, which is why paper trading is going to be your best friend. So let's say you are in 100% and you want to use a risk to reward ratio. This means you have a predetermined stop loss and take profit percentage before you even get into any play. This is just your plan. Your plan is I'm going to do this for every play. And risk to reward is on the screen. It shows you all the different types of risk to reward ratios. You have your 1-1, your 1-2, your 2-1, 3-1, 1-3. That percentage means that's the amount of plays that you need to win in order to break even. So if you have a 1-to-2 risk to reward ratio, as long as you are profitable on 33% of your plays or more, then you will be making money. So if your risk to reward ratio is 1-to-1, you will have a stop loss. Well, first of all, let's say you have to predetermine your stop loss and your take profit percentage. So let's say you pick 10% as your percentage. It doesn't have to be 10%. You can do 5%. You can do 7%. 7% is actually a pretty good one. But let's just say, just because it's easier to do the math for this, let's just say you pick 10% as your percentage. This means that once you set your risk to reward ratio, it's going to be based off of a 10% stop loss and a 10% take profit. So if your risk to reward ratio is 1-to-1, you will have a stop loss of 10% and you'll have a take profit at 10% on every single play. What this means is that as long as you are in 100% on the plays, on every single play, once you set your stop loss / take profit, that all you have to do now is win more plays or take profit on more plays than you stop out of in order to become profitable. If your ratio is 1 to 2, this means that you'll have a stop loss of 10% and a take profit at 20%. This means that as long as you win or take profit on more than 1/3 of your plays that you take, you'll become profitable. Because with a 10% stop loss and a 20% take profit, you can lose 2 plays, stop out at 2 plays with 10% stop loss, and win 1 with the 20% take profit, and guess what? You're even. A 2 to 1 ratio means that you're setting a stop loss at 20% and taking profit on every play at 10%. So you probably won't stop out of as many plays, but you'll have to win or take profit on more than 2/3 of your plays in order to become profitable. The opposite of the 1 to 2 ratio. So in order to use this strategy, you need to have a plan and stick to it, otherwise it won't work. So this means knowing exactly how much you want to allocate to each stock and waiting until you are in 100% of your position before setting your stop loss or your take profit. And this also means you cannot let your emotions get the best of you and make you change your plan. This is a stress-free, hands-off approach to trading. Might be good for someone who works 9 to 5. Because you really don't have to watch the charts or worry much due to knowing you already know when you're going to be selling, and you can just set it and set your sell, set your profit, set your stop loss, and just walk away. So in theory, if you're doing the drop rate ratio buy-in, so let's say every 3% or every time that the stock drops 2% you're going to buy it, you can set all of your buys right when you get into the stock, and then once you're in 100%, you'll get alerted. Your Webull will say, all right, you just made your buy at whatever percent, or whatever price. And then once you're in 100%, you go, all right, 10% stop loss, 10% profit, or 7% stop loss, 14% profit, or 7% stop loss, 7% profit, depending on what your risk reward ratio is. So in theory, you can do all this without even having to watch the chart, and you'll have to do trial and error to see which percent drop rate works best for you and what percent take profit and what percent stop loss works best for you. This is the most hands-off approach. This is the most stress-free approach. This is honestly what is used by a lot of new traders, or what is recommended for a lot of new traders, as opposed to trying to watch the chart. And if you're new, you might not know exactly what you're looking at. So you might think that you're making a good buy, but guess what? You're not. If you're just doing it at a certain percentage each buy, you're leaving it up to chance in theory, but sometimes leaving it up to chance is better than trying to do it yourself when you don't know what you're doing. So if anyone has any questions, now is the time to ask them. I'll answer a few of them here in the live stream, and the rest I'll answer in the PBU chat, which is the Pennybois University chat, which is free for premium members of Pennybois. If you aren't a premium member, join us at discord.gg/btpenny. We have great alerts, cats giveaways, and an amazing community, and free trading classes for our premium members. Our next giveaway is going to be for $100, and this is a e-gift card, which is basically cash. I will email you a gift card that you can just buy anything you want with it. Basically, you can use Amazon. You can buy anything on Amazon. You can print it out and use it as a store. Whatever you want to do with it, you can just do that. Use your Apple Pay for what you can just transfer it to your bank account. Whatever you want to do. It's basically like cash. So that giveaway is going to be on Monday for $100, basically straight up cash. And so make sure that you join before Monday to get in on the action. And if you already are a premium member, then make sure that you check out our raffle channel to find out how you can join the raffle. It's for free and easy to join. And make sure that you figure out how that all works so that you can win $100. And that giveaway is going to be on Monday. So let's see what questions we have. And just so you know, tonight, 9:30 p.m. Eastern Time Zone, we are doing a indicators class. So this is not our PBU class. This is just a bonus stream I decided to do randomly. We are doing our indicators class at 9:30 p.m. Eastern Time Zone. We're going to be going over simple moving averages and exponential moving averages and how that all works. All right, so let's see what questions we have. Austin has mentioned using the pivot point tool on Webull. Can you go over that sometime? I've been trying to figure it out. I don't know what setting works best. I personally I've yet to use that pivot point thing. I saw that Austin mentioned it, I actually was going to ask him about it and try to. I was actually going to also do some research myself and just kind of do some trial and error on it. But as soon as I do know more about it, I can definitely do a bonus class, like a bonus little YouTube video on that for sure, Miguel. Lucam Live asks, when is the giveaway? It's going to be on Monday. It's going to be right before Trading with Tagman, which is our live stream where one of our moderators or administrators, Tagman, who's been trading for a long, long time, he goes over a bunch of different techniques that you can use, that he uses, as well as how our Discord works and how our premium alerts work. What are those circle indicators he uses? I think that is the pivot points, or that might be the Fibonacci retracement tools. But once again, those are two things that I personally have yet to use myself. I'm still kind of doing a little bit of research on it. But once I do know more about it, I know that he's going to be making some videos on that as well. But I definitely can make some like more basic, the quick basic version of it, because I know it's a little confusing sometimes. Add on to my question, I think the pivot point tool would help out us noobs since it'll show support and resistance points and also help give us an idea of when to make buys. Yeah, no, definitely. It's always good to know when support and resistance is. I am going. What's going on, Jacob Lau? Hey, Jacob. Speaking of Jacob, I know he's on the screen right now, or one of his posts is on the screen right now. So shout out to Jacob. I know finding support and resistance is really important. I did do a class on that in the Pennybois chat, in the PBU chat, and I will be making a YouTube version of that. I believe KevCave, I believe you are right. The circle things that Miguel is talking about, I'm sorry, that Zayas is talking about, I believe that, or Juko is talking about, I believe that is the Fibonacci arcs. So yeah, so Fibonacci arcs and pivot points are something that I will do some research on, and we can do a little mini bonus video, mini bonus class, kind of like this one was on that for sure. But yeah, as far as support and resistance goes, we did go over like all the different support and resistance indicators that you can use in your Weeble app. We went over that in our live stream. And some of those indicators are, I'm just going to pull it up really quick. Yeah, we went over the Bollinger Bands, the Donchian channels, the envelope, the Fibonacci levels, the Ikimoku clouds, and the Keltner channels. And I pronounced probably all those wrong, but we did go over all those, and I'll be making a video kind of based off of what we just went over in that live stream. I'm making like a video version of it on YouTube. When it comes to placing stops and averaging down, Lucam's Live asks, do you have any 2 to 3 sentence advice on how to balance the two? I know you touched on it. I just feel like it's super tailored to each person and what they're willing to lose, which feels like emotions. So when it comes to placing stops and averaging down, do you have any? So yeah, so when it comes to placing stops, so averaging down is something that we try not to do. Averaging down is when you're in 100%. Like if you're bag holding and you're like, I'm trying to get out of the stock, I'm going to average down. That's averaging down. What we do is if you're not in 100% and you're making buys, all you're doing is just buying into your position. You're just developing a position. So as far as what I personally do, because it's just easier and less, less stressful, is I have a percentage that I have a drop percentage that I use. So like every time that the stock goes down 2%, I'll just put in a buy. So I'll do a 5% buy, and then once it goes down 2% again, I'll make a 10% buy, and then I'll make a 15% buy, maybe like another 10% or another 15%, so on and so forth until I'm in like around 75%. And then I will either just make one more last buy at 2% and then set my limit and set my stop loss, or I'll wait a little bit and see if I can, if I can find any confirmation. But honestly, recently I've just been setting all my buys at once. Like as soon as I get into the stock, I'll just set all my buys, 2% drop rate. What happens happens. Once I'm in 100%, then I set my take profit and my stop loss based off of my risk to reward ratio. Right now I'm using a 1-to-1. So I'm taking profit at 10% and I'm taking loss at 10%. So far I've taken a loss on one play and I've taken profit on 3. So in theory, it's working out for me, but it's just going to take some time for me to see if that is the plan that I want to use going forward, because it is, it's trial and error. But yeah, for most people, it's really what works. If you are able to watch the charts and you feel confident watching the charts, then you can make those buys based off of support and resistance. So every time you fill a buy, you adjust your stop. No. So I wait until I'm in 100% to do my stop loss and my take profit. So let's say that it's alerted at 50 cents, and let's say I want to try to buy it. Like I'll do my first buy based off of a support. So if it's alerted at 50 cents, I'll make my first buy at 48 cents, let's just say. And then right off the bat, I'll determine, I'll use Excel or some kind of mathematical whatever to determine what 2% drop is. And every time that it drops 2%, I'll set limit buys for every 2% drop, like at 5%, 10% buy, 15% buy, 20% buy, 25% buy, 25% buy, or something like that. You can do whatever percentages you want. And then, I walk away. And then when I'm in 100%, then I'll be like, all right, time to set my stop loss, time to set my take profit. It's kind of like a hands-off approach. It kind of takes the emotions out of the trading. And so far, like I said, it's worked 3 out of 4 times. And my risk-to-reward ratio is 1-to-1. So as long as I win more than I lose, or as long as I take profit on more than I stop out, once I'm in 100%, well, then I'm going to be profitable. So you're setting your position may sometimes place you down about 6%. So you point out. Okay, so Lucum says, so you setting your position may sometimes place you down about 6% or so, as you pointed out with the buying in on the 2% drops. So every time that it goes down, I'll buy, and I'll do it in increments, so I'm buying more, like a bigger percentage as it goes down. So like, honestly, I'm usually not down more than, until I'm in 100%, my actual P&L for the stock is never usually more than negative like 2% or 3% because of the way that I'm buying. I'm buying more as a bigger percentage as it goes down. So it's at 50 cents. I bought 5% of my position. Rock your mic. What's going on? What's up, penny boys and gals? So I'll buy 50 cents with 5%. Let's just say. Then if it hits like 46 cents or whatever the next whatever 2% down from that is, and then I'll buy like a 10%. Then I'll buy like 15% once it goes down a little bit more, and then 20%, and then 25%, and so on and so forth. That way, as it goes down, my average is going down. So even though I'm buying at 48, then 46, then 45, or 44, whatever. By the time it's at 44, my average is now 46 or 45, and change. Got any more questions? I'll be happy to answer them. What if you buy the bottom and it never falls from your first buy point? Then I'll just, if it goes up to, at that point I'll just take profit. If it skyrockets up, I'd rather risk that. I'd rather risk taking profit with, a little bit in than, risk the opposite, which is going all in and then taking a big loss. I'm going to give y'all a chance to ask more questions while I get my charger hooked up. I hope y'all enjoy the music while you ask your questions. Brace your ears. All right, I am back. Let's see. Okay, we got some good questions here. It looks like That's good to know, says Lukems Live. I'm hard stuck in oil stocks waiting for the hurricane to pass. Once once we survive that, I'm going to start playing by those rules. Yeah, that's honestly, that's all about just figuring out what works best for you. And like I tried. This is like my third plan that I've been working on right now. And I'm gonna see which one is the best, like the most successful, I guess. Like I said, it's just trial and error. It's just when you're new to trading, it's just trying to figure out what works best for you before you start putting some big money into the market. And if you want, you can always use those retirement alerts that we have, the long alerts. You can use like a Robinhood account and do long alerts in the meantime while you play around with your penny stocks and your plan and all that. That way you have your retirement alerts and your long account that you're making money on while you know, mess around with everything else. Because when practicing and trial and error, you could end up losing some money. And if you're not paper trading, then it's good to have that Robinhood account, a long account to kind of compound the losses, kind of make up for the losses that you're making while you're learning. But it takes losing in order to make money in the long run, or in order to learn how to what not to do and what to do in the long run. And that's the whole point of this Pennybois in general, is to become better traders in the long run, so that a year from now, 3 years from now, 5 years from now, you're really making some good money from what you've learned and from what you've experienced. We're not just about giving you here's the top 5 runners of the week, or runners of the day. Let's try to get in on them and make some profit. Let's try to chase these stocks. Like, that's not what makes you a good trader. I mean, that's like, well, it's just not a great way of trading in general. And once all this volatility, once the coronavirus and all this stuff goes away, that's not gonna people who are in those type of alert systems are going to be in for a very rude awakening once they realize how trading actually is. But yeah, I hope that helped. Thanks for joining, everyone. Thanks for joining Justin Knutson, Juco, Lukens Live, Kev Cave, Mafus Samar, Velvy Green, Candy Diet from the PBU. We have John Goforth, and Kev Cave, of course, Miguel Gonzalez, and Jacob Lau, who is on the screen right now, and Rock Your Mic. Thank you all for joining, and anyone else who's in the stream. I hope that helped. Make sure that you join us tonight. We're going to be doing our indicators. That's not it. That's the grand prize, which we will be doing on Monday, is our grand prize $100 gift card giveaway. But what we're going to be doing is our indicators class tonight at 9:30 p.m. Eastern Time Zone. So I hope that you join us then. We'll be going over some moving averages and some great stuff like that. Brian, what's going on? Now, this is just an impromptu stream, Brian. We still do have our class tonight at 9:30. So you'll definitely be able to join us then, 9:30 Eastern Time Zone, 9:30 p.m. That's tonight. We hope to see you there. We'll see you there, Jacob. Jacob's been absolutely killing it lately, making that bread, making those profits, getting that knowledge in his brain, dropped into his brain, and it will be on Lukem's Live. This one's going to be on YouTube. But I will also post a link on Discord for tonight's class. Yeah, Jacob's been killing it. So yeah, we will see you guys then. I'll be in the PBU chat still to answer any questions that anyone has. And if you're not already in the PBU, then if you're a premium member, then just join us. It's free for premium members. And if you're not, then you can join us at discord.gg/btpenny. So that you can join me, you can join Jacob, you can join Rock Your Mic, you can join Brian, you can join Kev Cave and the rest of the crew, like Playlits and Matster and Pookie's Revenge. You can join us all and make some bread. All right, we will see you at 9:30 tonight.